Think about it. How cool would it be if we legally rob the banks together and take the money back which they are stealing from us with their money printing machine by simply following their dirty tricks and footprints across all financial markets? If that's cool, stay tuned till the end of this presentation. It will cost you 30 minutes investment of your time right now. We all can feel that life is getting more and more expensive because the banks keep printing money like crazy. For many people, this inflation is getting really serious. I know that already 80% of our people can feel the inflation in their pockets heavily. Everything gets more expensive, but they still earn the same money. Most people invest their time to make some money, and there is nothing wrong with it. The problem is that they print more and more money, lowering the value of the money which you are working for by investing your time. And they just press the button, make everything more expensive, and steal our money. I think that's not fair. It should not be like this, but that's the way the world is. I can't change it. You probably can't change it. And it doesn't make sense at all to complain about it. The only thing we can do to change our situation and earn more money is by learning new high-paying skill sets. So, if you don't want to be one of the sheeps on the way to the slaughterhouse, you need to listen carefully. In today's video, I will break down my high-volume trap trading strategy for the New York session that has helped me to make 200% profit in 2023 with an average of 2 hours work per day. I will share my strategy and execution plan with you 100% for free because I don't need your money. I have everything I can dream about. I'm healthy, I have a good family and awesome friends around me. I have the freedom to do whatever I like every day. I am free, and now it's my time to help uplift others and show them the right path. My intention is to teach a small group of people and build up a community of winning traders who work together across all different financial instruments. A group of traders that work on the same goal, help each other, make money together, support their families, and live a prosperous life with the freedom to be able to do whatever they want every fucking day. If you're ready, grab a notebook and a pen, and then let's get into it. I made around $2 million in profits in 2023 with this strategy, and I'm planning to make another $5 million till the end of 2024. The strategy that I'm going to teach you today is exactly the strategy that I'm using. It's beginner-friendly and simple to execute as we have a clear set of rules. I will hand out the manual and I will guide you through every step in this video here. After this video, you can get to your charts and start testing the things you will learn today. My results or the results of my students are not an indication or guarantee for your future results. I'm not a financial advisor, and this material is not a financial advice. Trading is risky, and you can lose your investment. Please use demo accounts when you want to test any idea from this material. Thank you. The high-volume trap strategy is a very specific pattern around a specific zone that appears at a very specific time of the day during the New York session. We trade this pattern exclusively on NASDAQ or SP 500. The strategy basically aims for a reversal move around clearly defined significant areas where retail investors getting trapped. I look out for this specific trap reversal pattern between 9:30 a.m. to 11 a.m. New York time. Write it down, 9:30 till 11 a.m. New York time. Before we get into the step-by-step execution plan for this strategy, I need to explain the logic behind this system and the market movements and market maker manipulations to build a solid foundation and to make sure everything I will show you in this presentation makes sense. Let's get a few facts straight. First of all, the Forex and index markets are highly manipulated and controlled, and you don't need sophisticated tools to understand how this is done. However, for the majority of retailers, it is not easy to determine when and how this happens because they simply don't know how it works, and it's not their fault. It's because of the nonsense retail education out there that everybody buys into without asking the right questions. Why does the market move? When does the market move? And how does the market move? 95% of retail traders lose because they don't understand the mechanics of a financial market. A market is a place where buyers and sellers come together. These buyers and sellers execute their trades through brokers who are making a profit through a commission for every transaction. So the broker is basically the connection between the trader and the real market. Every transaction that is carried out in the financial markets must have a buyer and a seller. Only when we have both, we have a trade. This process is usually done electronically in a fraction of a second. In essence, every time you step into a buy position, you are matched with someone who is happy to be sell and take the other side of your position. If this does not happen, there would be no trade. That's why there are big institutions like hedge funds and central banks who provide liquidity to the market to make trading possible for everyone. And it's very important to understand how these big institutions work. Why is that so important to understand? Because it highlights the problems that these big banks and institutions face, which small retail traders don't have. If you think about it, every retailer is able to bring any desired position size to the market without fear of slip-ups at any given time. Maybe important news events like central bank announcements can cause a slippage for a retail trader, but regularly most trades for retail investors are always executed instantly in a fractal of a second. That means if you trade one standard lot as a retail investor, you will have no problems getting the position in the market at the price you want instantly. But now imagine you want to trade much higher volumes, just like banks and institutions need to do, maybe a 10,000 times bigger position in one trade. Do you think they can do that without the market to collapse or spike up, causing slippage? No chance. When you have to move big volumes, the market will move big time. They cannot bring these big volumes to the market at any time because they need others traders to take the other side of the trade. If there is no trader on the other side, the market will just slip like crazy. So they have to find a way to get other traders on the other side of their trade to make sure they get the best price for the big trade. Let me tell you, they have a very simple solution to make it possible. Now I want you to imagine that you are this big institution, bank, or market maker, and you have to get a gigantic position into the market without causing the market to collapse or explode. What would you do if you was them? The goal is to make as much money you can, so there are three options you can choose from. Option 1, you could either bite the bullet and accept the price you get. The big problem with this is that you are not getting the best price to maximize your profit. Option 2, you can wait for the price to reach the price level you want to get the best execution possible. But if the price does not reach the desired level for you to complete the trade, you get forced to leave without making a trade, or you have to take whatever price you can get because the trade is absolutely necessary. Doesn't sound clever if the goal is making money. So let us talk about option 3. You bring the price to the level where you can collect a lot of traders who are willing to take the other side of your position. So you manipulate the price in the opposite direction of the target direction so that the small investors take the other side of your position so you can get the desired volume in the market at the best price. Which option would you choose if you are the market maker? Option 1 means you leave a lot of profit on the table. Option 2 means you have the risk of not being involved or getting a shitty price. So you have to go with option 3, of course. And this is what they do most of the time. And our job is to spot this scenario and follow their footprints. I will show you exactly how it's done. So how do they do it? To steer the market to the desired price, they take large positions in the market. This is similar to the case in which large companies compete aggressively to drive smaller companies out of the market. This is how the manipulation works. The big players who have the money to steer the market in the direction they want do that regularly. Furthermore, they do that because if they don't manipulate the market, they won't be able to carry out their large orders. Think about it. What makes the price goes up or down? When more people want to buy something than sell it, the price goes up because the demand is higher than the supply, more buy orders than sell orders. On the other hand, if more people want to sell something than buy it, the price goes down because the supply is higher than the demand, more sell orders than buy orders. So if a market maker steps into the game with a massive order to buy a market, what happens to the price? It will start to rise. That means that the market maker offers a higher price and is forced to buy at even higher prices until his order is fulfilled. That's why the market makers have to do the opposite of what they intend to do in order to bring the price to the desired level, where they can get their initial big position into the market without slippage, having the retail traders trapped on the other side of their trade. Remember, a trade can only happen if you have a buyer and a seller, and that's why they have to do these manipulations when it's time to initiate a big position into the market. And the best time to do that is around the high volume times when all market participants are involved. Let's talk about the logical explanation of price movement. First, you should accept that market makers are massively moving the markets for their interests. And it is very important to understand that they are doing everything possible so that they can earn as much as possible. This can be seen in the price charts, and I will show you exactly how to spot these fake moves. Almost all price reversals occur on false breakouts, and it is nothing more than collecting buy stop or sell stop orders before reversing the market. That's what we are looking for. We want to see buy stop or sell stop orders get collected, and then we want to see our reversal pattern get printed to confirm the trap and find our entry and direction with the market makers. Now you probably have a few questions, and I got the answers. 1. When do we want to see these manipulations print? 2. How does it look on the chart and where does it appear? 3. How can we participate and execute in those movements? And what's the exact entry scenario? This is what you are going to learn right now. Let's talk about it step by step and get into the execution plan for this strategy. I advise you to watch this video multiple times and write the game plan down. The manipulations happen mostly around the high volume times, and we only focus on our entry for this trap reversal setup between 9:30 a.m. till 11 a.m. New York time. The trade itself can be hold longer than that, sometimes up to a few hours or maybe even until the next day, but the entry can only be taken within this specified time window from 9:30 a.m. till 11 a.m. Where does these manipulations and trap reversals appear, and what are the characteristics? These manipulations happen above or below a significant high or low where a lot of orders are sitting. This is the example for a buy stop liquidity raid and a sell stop liquidity raid on the higher time frame. It doesn't have to be an equal high or equal low. It can be any significant high or low you can see on the chart. For example, the previous session high or low, or previous daily high or low, or the previous weekly high or low. All these significant highs or lows are full of buy stop or sell stop orders where the market can make a lot of transactions. So we want to see these buy stop raids or sell stop raids above or below these significant highs and lows first. We want to see traders get trapped. Please write it down. The first thing we want to see for our strategy is that a significant high or low from the higher time frame gets taken out. We call it buy stop or sell stop liquidity raid because many buy stop orders or sell stop orders sitting around these significant highs and lows. I use the 1 hour chart as my higher time frame where I look out for significant highs or lows. These liquidity raids can happen before our predefined time window, and that's okay. It doesn't have to be inside our predetermined time window between 9:30 a.m. to 11 a.m. Only the entry pattern that we are going to talk about next has to form within that specific time window. How can we participate and execute in those movements, and what's the exact entry scenario? So the next thing we want to see is a structure shift on the lower time frame with clear displacement leaving a gap. I use the 5-minute time frame as my lower time frame to look for this specific entry pattern. And the displacement is the most important part of this pattern. Without clear displacement, the market will probably not reverse. So we have to wait for strong displacement with a gap in between. Let me explain to you what that gap means. The gap is a 3-candle formation that looks like this. We talk about a bullish gap when the first candle's high and the third candle's low leave a gap in between. It is an indication for strong price movements, and that's exactly what we want to see. We want to see strong price movement that shifts the lower time frame structure. That's the displacement we are waiting for. Same thing for the bearish gap. When the first candle's low and the third candle's high leave a gap in between, then we can identify strong price movement. And that's what we want to see when we are looking for the displacement that shifts the structure on the lower time frame. This gap is important for our entry scenario because we wait for the pullback back into the most recent gap of the displacement that caused the shift in structure on the lower time frame. Our entry will be on the pullback inside this gap during the time window between 9:30 a.m. to 11 a.m. New York time. If price moves quickly and leaves multiple gaps in a row without a pullback, then we can use the closest gap for our entry as well, but only if it's possible to get a 2-to-1 risk-reward ratio to our profit target at the next zone of liquidity. This is important. If the market can't offer a 2-to-1 till the next easiest zone of liquidity, then we should better stay out or wait for the first gap to get touched. Where do we place our stop loss? We place our stop above the recent high or recent low of the displacement. If we buy, we will put the stop below the displacement, and if we sell, we put the stop above the displacement. Where do we take profits with this strategy? The minimum target we aim for is a 1-to-2 risk-to-reward ratio. You can either set a fixed take profit at around 1-to-2 for every trade setup like this, or you can watch out for zones of liquidity on the left side of your chart that you can trade into to maybe make even more than a 1-to-2. Especially when you are in direction of the overall big picture trend, this can lead to much bigger profits if you have the patience and confidence to hold through. Speaking for myself, I like to pay myself and take profits at the easiest and most closest zones of liquidity, which are most of the time somewhere around 1-to-2 and 1-to-3. And I advise you to go with these numbers as well at the beginning, to collect data for your trading journal, to grow your confidence in the strategy, and to later on find out where the sweet spot for you is. Let's do a quick calculation to boost your confidence. If you have a trading strategy that is 50% of the time correct, with an average risk-reward ratio of 1-to-2, then you have the license to print money. That's all it takes. 50% accuracy and 1-to-2 risk-reward. Let's do the math together. For example, if you lose a trade, you will lose 1%. But if you win a trade, you make 2% profit. So you win 5 times, which is 10% profit, and you lose 5 times, which is minus 5% loss. So overall, you would be 5% in profit. Simple as that. Now let's say you have a little losing streak and you lose 7 trades out of 10, which is a loss of 7%, and you only win 3 trades, which is a 6 profit. Then you would only face a 1% drawdown overall. I think that's really awesome, and it should give you a lot of confidence to execute every single setup that you find. I'm giving you this calculation because I want you to think about trading in terms of probability. We have put the odds in our favor with this strategy. We have a simple but very specific pattern at a very specific time of the day that we can repeat with ease. That's what trading is all about. You need a simple approach that you can do over and over again. It will be boring at some point, which is normal, but it will pay out big time if you are consistent and disciplined. Now let's go over a real market example to see what it looks like on the real chart. This is the SP 500 movement from the previous day. We mark up the high and the low of that previous day because these are the most recent significant levels where all buy stop and sell stop orders are waiting to get tricked. Now watch closely how the market triggers the buy stop orders and then reverses to the downside aggressively to collect the sell stops that are resting on the other side below the previous day's low between 6:30 a.m. to 8:30 a.m. New York time. The first criteria for our trading setup is given. We can clearly see a higher time frame liquidity raid below the previous day's low. So now we want to see a lower time frame displacement that shifts the structure to the upside and creates a gap. Best case scenario between 9:30 a.m. to 11 a.m. New York time. I use the 5-minute chart as my lower time frame. This is what we like to see. Shift in structure that leaves 2 gaps already. Now we need to wait for the right timing and plan our entry. The last gap that was printed only offers a 1 to 1.5 risk-reward ratio, so we are not interested in taking this one. We need at least a 1 to 2 risk-reward ratio, so we wait for the first gap to get touched, and then we jump in. There we go. Around 9:55 a.m., our buy limit order gets triggered at the top of the gap, and we are in the game. We place our stop below the low of the displacement. Target is the most recent significant liquidity pool around the high of the previous London session, where buy stop orders are waiting for execution. Now let's have a look at the outcome of this trade. Look how beautifully this thing got to our target within a little bit more than 1 hour. We call it a day and turn off the screens. Mission complete. Time for some fun. In case you are using a static risk of 1 to 2, you had the chance to get out a little earlier. I personally like to close 80% of my position around a 1 to 2 risk-reward ratio and then let the rest run without risk for higher targets. This helps me to prevent that regretful feeling that will kick in when I see the market skyrocket without me on board. It's just a psychological trick that helps me to stay calm. I pay myself early, but let a small piece of my position in the market to ride the bigger moves as well. Simple trade management rule, but powerful for your peace of mind, you will see. Sometimes the market will just keep moving until the end of that trading day, and then you can close your remaining 20% of the position with a big smile on your face and a big profit in your account. I prepared a special PDF for you with some more trading examples to help you deepen your understanding of the high-volume trap strategy. If I did not send you the PDF already, please drop me a private message. You can find the details in the description below. So, I have given you the strategy that has helped me to make $2 million in 8 months. But how do we proceed from here? It's time for you to make a decision. Are you serious about starting this journey to become an independent trader? Do you want my help and join the inner circle of our team? Do you want to get trading signals according to this strategy while you practice the execution and develop your skill set? I need your full commitment if you choose this path, because I will invest my time, be your mentor, and share all my wisdom with you. If you are serious about this, send me a message right now. Tell me that you are serious about this, and I will add you to my Signal channel, where I will share every trading decision with you and give you further instructions on how to execute the strategy step by step. I made another video for you that shows you the complete process from A to Z. I will send it to you in the private chat. Just let me know that you need the step-by-step guide, and then we start the training. In this video, I will show you every single step that you have to take for your first trade with the Index Sniper trading strategy. You will learn exactly how to set everything up correctly, how to prepare your trades, and how to execute according to the strategy. Step 1. Visit ottmarkets.com and create an account with your details. After registration, you have to confirm your email. Please check your spam folder as well. Step 2. Log in on ottmarkets.com and click on See Trader in the menu on the left side of the screen. Now scroll down to create a demo account. Choose the account type and the account size you want to trade. I prefer ECN Institutional, as it has the lowest trading costs. Click Open Account to finalize the account creation. Step 3. Open your email inbox and wait for the email from CTrader with the headline, Action Required, Set Your CTrader ID Password. You have to set a special password for your CTrader ID. You only need your CTrader ID and the password to get access to all your accounts. This step is important. Wait for the email and set your password. Step 4. Go back to your client area on ottmarkets.com and click on See Trader on the left side of the screen. Now it's time to download the platform. You can choose the Windows version if you want to use your laptop. You can use Android or iOS to download the See Trader for your mobile device, or you can use the web terminal on every other device. If you are running a MacBook, please use the web terminal. I will use the Windows platform for this tutorial. You just need to click on the button and then install the CTrader. Step 5. Start the CTrader on your device and log into your CTrader account using your CTrader ID and the password you have set up in Step 3. Step 6. Set the time zone to UTC-4 New York time. On the laptop, you can easily change it on the bottom right of the screen. If you are using your phone, you have to go to the settings and then change the time zone from there. Step 7. Add the NASDAQ and SP 500 to our watch list. First of all, I want you to create a new watch list. Make sure that you expand the menu on the top left so you can see the watch list tab. Now click on plus create new watch list and give it a name. After that, click that plus button next to the watch list name to add the NASDAQ and SP 500. Click on indices, spot, and search for SPX USD and NDX USD. SPX is SP 500 and NDX is NASDAQ. Step 8. Open a new chart for SP 500 by right-clicking on the symbol name inside your watch list, then New Chart. Do the same thing for NASDAQ. Step 9. Customize the colors of your chart so you feel comfortable. I like to trade with green and purple candles, and I like to make the grid transparent, and I like to make the tick volume transparent. Make sure that you give the period separator a color so you can easily see where the previous day has started and where it ended. This will help you to mark up the previous day high and low. Step 10. Choose the correct time frame. I like to use the 1 hour time frame H1 to look out for recent significant highs and lows. You can switch to the 1 hour time frame on the toolbar on top of the chart, or you can right-click on your chart and click period, then standard, then select 1 hour. Step 11. Mark up the most recent significant highs and lows in the 1 hour time frame. Use the horizontal line from your drawing tools on the right side of your chart to mark up the previous day high and low. Step 12. Go to the 5-minute time frame to mark up the previous session's highs and lows. Before the New York session, we had the Tokyo session between 19 p.m. and 4 a.m. New York time. Let's mark it up with a vertical line from your drawing tools on the right side of your screen. Give the Tokyo session a color. The next session we have is the London session between 3 a.m. and 12 noon. Let's mark it up with a vertical line as well. And then we have the most important session for our strategy. The New York session is between 8 a.m. to 5 p.m. Mark it up with a vertical line as well so you have an idea of where the session highs and lows are. Step 13. Now that you have marked up all the sessions, it will be easy for you to mark up the recent highs and lows of the previous sessions, which are important for our entry scenario. As you know, we are looking for our entry scenario inside the New York session between 9:30 a.m. to 11 a.m. So make sure to always be in front of the charts before 9:30 so you have time to mark up the highs and lows that are important for our entry scenario. Step 14. As you know, we want to see a liquidity raid above or below recent significant highs or lows. It can be the previous session high or low, or it can be the previous day high or low, and it can also be the previous week high and low. So make sure to have all these levels marked up so you see when the market raids the liquidity. Step 15. After we have spotted a liquidity raid, we want to see our reversal move with clear displacement that shifts structure and leaves a gap on the 5-minute time frame. So we wait patiently for our clear displacement with a gap, and then we start planning our entry. Step 16. Mark up the gap as soon as it appears. Now use the crosshair function from your toolbar on the right side of the screen to check the exact price for your entry. Write down this price or keep it in mind, then check the exact price for your stop loss above the displacement and write it down or keep it in mind. Step 17. Click on New Order on the top left of your chart to open the order window. Choose Limit Order on the left side, then select Sell Limit if you want to sell, as I do in this example. For buy entries, you use Buy Limit Order. Next thing you have to set is the entry price you have written down, and then activate the stop loss function to type in the exact price for the stop loss price above the displacement that you have already written down. Step 18. Now you have to adjust the correct quantity. The quantity is your trade volume. We call it lot size. If you change the quantity, you can see how the numbers below the stop loss change according to the quantity. This will help you to use the correct percentage risk for your risk appetite. I want you to take a look at the estimated balance. Let's say we want to risk 1% with this trade. So you have to adjust the quantity until you can see 1% estimated balance in the stop loss settings. When everything is set as you want it, risk management is in place with the correct entry and stop loss price, and the quantity is correct set according to your risk appetite. Then click Place Order. Step 19. Now you wait until the market comes back into the gap to trigger your sell limit order. Step 20. When the market triggers your entry, you can start thinking about where you want to take profits. As you know, I like to close 80% of my position at the first easiest targets and then let the rest run for further targets. For the beginning, you can start with a profit target of 1 to 2 risk-reward ratio, or you can just place your target at the next significant high or low. In the case of a strong trending market, we sometimes don't have these significant highs or lows as targets, so we should go with an easy 1 to 2 risk-reward ratio. That's the step-by-step plan for your first trade execution according to the strategy. And now let's go over 3 market replays so you see step-by-step how I would execute this step-by-step execution plan, so you see exactly what your job as a trader looks like. I do not mark up the different session beginnings with a vertical line in that case, as I know where the sessions are, but you should do that in your charts, especially at the beginning, to train your eyes. So it's the same thing over and over again. I start by marking up the highs and lows of the previous day and the previous session. Then I wait for a liquidity raid above or below these significant highs. Once we have a liquidity raid, I wait for our reversal move between 9:30 a.m. and 11 a.m. New York time. I want to see clear displacement that shifts the structure on the 5-minute time frame, which creates the gap. In this buy scenario, I want to get in at the top of the gap. So I use the crosshair tool and check the exact price at the top of the gap for my entry, and then I check the exact price for my stop loss below the displacement. Then I add these numbers to my limit order window, and then I finally adjust the quantity to make sure I only risk 1% on this trade if the market would hit my stop loss. The first trade gets triggered after we have set up our buy limit order. This trade runs straight to the target above the session high with a 1 to 4 risk-reward ratio. That's a profit of 4%. On this account size, it would be around $19,000 profit. Let's fast forward to the next trading day so we can run through our routine. For the next trade, I do the exact same thing. Let's do it again. I start by marking up the highs and lows of the previous day and the previous session. Then, I wait for a liquidity raid above or below these significant highs. Once we have a liquidity raid, I wait for our reversal move between 9:30 a.m. and 11 a.m. New York time. I want to see clear displacement that shifts the structure on the 5-minute time frame, which creates the gap. In this buy scenario, I want to get in at the top of the gap. So I use the crosshair tool and check the exact price at the top of the gap for my entry, and then I check the exact price for my stop loss below the displacement. Then I add these numbers to my limit order window, and then I finally adjust the quantity to make sure I only risk 1% on this trade if the market would hit my stop loss. Then I click Place Order and set my target at the most significant recent high. The second trade gets triggered after we have set up our buy limit order. This trade runs to the target above the most recent significant high of the previous day with a 1 to 2 risk-reward ratio. That's a profit of 2%. On this account size, it would be around $9,000 profit. Let's fast forward to the next trading day so we can run through our routine. Let's do it again. I start by marking up the highs and lows of the previous day and the previous session. Then, I wait for a liquidity raid above or below these significant highs or lows. Once we have a liquidity raid, I wait for our reversal move between 9:30 a.m. and 11 a.m. New York time. I want to see clear displacement that shifts the structure on the 5-minute time frame, which creates the gap. In this buy scenario, I want to get in at the top of the gap. So I use the crosshair tool and check the exact price at the top of the gap for my entry, and then I check the exact price for my stop loss below the displacement. And then I finally adjust the quantity to make sure I only risk 1% on this trade if the market would hit my stop loss. In this case, we have a strong bullish market, so we don't really have a visible target on the left side of our screen. So we can use our 1-to-2 risk-reward ratio and set our target there. This trade smashes through the 1-to-2 target as well after our buy limit order got executed. We take the 2% profit on this trade as well. All three trades made it to the target, and we made a profit of around 8% in just 3 trades, risking only 1% per trade. That's nearly $37,000 on this account. If we had risked 2% per trade, we would have banked twice as much, which is around 16%. That's $74,000 on this account. With a 3% risk, it would have been a 24% profit in just 3 days, which would be around $111,000. This strategy has an extremely high hit rate if you execute it correctly, but on some days, you won't find an entry scenario, which is part of this strategy. This strategy is very specific, and you have to be strong and wait through those days and don't trade. Give yourself a favor and don't break the rules. Otherwise, the market will humble you. If you need any assistance, please don't hesitate to contact me. I want to see you succeed with this strategy, so make sure to keep me updated about your progress. If you need my help, I'm there for you. I wish you much success. We talk soon.